Hello and welcome to episode 10 of Insider Investing. This is the day when Russia has finally invaded Ukraine. On this episode, we talk about the origins of this conflict, the impact, and if this is the Lehman moment of 2020s. We also talk about how investors need to react in times like these. Watch out for this very important episode. So today is 24th of February 2022 and a big day, an interesting day. A lot of events have come to head. Till yesterday we were hearing about Russia hacking into or doing a cyber attack on Ukraine, and today we finally see Russian troops invading into Ukraine. Uh, while a lot of this has been in the works for some time, this is truly a very interesting event in geopolitical history. I think many years later we will talk about this day when actually Russia invaded a neighboring country. Now, everyone has a different perspective on this. Russia's perspective is obviously, or at least the stated objective is that they are helping a part of Ukraine become independent. They want to go independent, and Russia is just helping it. Ukraine's point of view is obviously that these are separatists and this part is integral to Ukraine. And the Western world's view is that this is Russia's act to prevent NATO from expanding and threatening the geopolitical security of that region. What for me is interesting, and I think this is something that I realized only recently, is that on one hand we have Putin, whom we all know has been in power now for 23 years. He's a previous KGB spy, so obviously understands how to play this game really well. And on the other hand, we have Zelensky, which is the Ukrainian president, who's actually a former comedian. And this is his first term in power, and he's been around for 3 years. So not only does Putin have an upper hand in terms of power and money, etc., but in terms of experience and really depth, potentially Putin is much, much stronger. Hi, Vaibhav. Welcome back to Insider Investing. You are also returning this time from Kashmir. And what have we come back to?
Yeah, absolutely. Hi. Happy to be back, Sandeep, and similar feelings. So as you said, everyone has a narrative. Even for Kashmir, everyone has a narrative. Pakistan wants to say that they are helping the separatist. Kashmiris believe that part of Kashmiris believe that they need independence, and India believes that it's an integral part. Obviously, we would want to be with India on this narrative, but every country will have its own narrative, and these are absolutely interesting times. One thing which I've realized and I've been studying about it is after World War II, the autocratic culture of running a country had dissipated significantly. But over last 7 to 10 years, again it is starting to rise. You have Putin in Russia, you have Erdogan in Turkey, and you have Kim Jong in North Korea. So people believe that autocratic culture will come back and they will solve for all their problems. And somehow it is very similar to how it played out in Germany of World War II, where everyone believed that democracy had failed the country and they needed a powerful leader to navigate them through the crisis. So that's
Yeah,
that's where we are.
yeah, it's interesting, Vaibhav. I think some of it is also being fanned by the social media, right? We saw earlier this week Trump launch Truth Social, and the truth and Trump in the same sentence is interesting to have.
It's
Uh,
oxymoronic.
it's oxymoronic, but what seems to be happening is that even within countries, one part of the polity or country is not talking anymore to the other part. Everyone is in their own echo chambers, and some of it is also, I think, in how social media is created, right? If I follow a set of people, social media will recommend to me content from that set of people or those type of people, so that bubble only gets hardened and hardened, and
Yeah.
before you know it, you're not listening to the other side at all.
That amplification of view is constantly happening because you're listening to the same voice again and again. And
Correct.
that's the problem because that's how algos work. To keep you engaged, they want you to listen to the same thing that you want to engage with.
Absolutely. And for me, the obvious worrying point is that in this, from sitting here in India, in Mumbai, we are comfortable, we are in our air-conditioned rooms. But on the other hand, on ground, uh, there will real people who will suffer in this conflict. And for us, while and we'll discuss it, is the economic impact, the impact on markets, on our portfolios, and so on in the next 15-20 minutes. But what is really going to be worrying is the human impact of this. US believes that at least 50,000 people will die in
Yeah.
case a war does, full-fledged war does break out. Uh, and who knows what long-term implications that has on the life of people. We saw it in the post-World War era, especially in the aftermath of the nuclear bombings on Hiroshima, Nagasaki. Those generations took a long time to come back from that. So
Yeah.
that for me is the real concern and the worry and story of this conflict.
No, absolutely. And I believe and I hope that all of us have learned our lessons from Hiroshima and Nagasaki, and any kind of nuclear war will not happen again. Uh, all the countries with their nuclear weapons have created a deterrent. So, more in terms of ensuring that other countries don't attack them.
Yeah. For me, and this is an important part that like mutually assured destruction is
Yeah.
one aspect of geopolitics which is possibly holding wars back.
Yeah.
And if you see the concept of NATO, NATO was built on the concept that if any of NATO members is attacked, it is an attack on all the NATO members, which
Yeah.
means that theoretically they also have to jump into action.
Yeah. Yeah.
Now, as of now, Ukraine is not a member of NATO. So, theoretically, NATO is not going to be pressed into action automatically.
Yeah.
But if the crisis spreads to the western parts of Ukraine and then into adjacent countries of Ukraine, which are NATO members, it can be quite worrying, and
Devastating. Yeah.
potentially then it could be a full scale war. But Vaibhav, let's move to what we think is the near term issues or the problems that this can cause. Especially explain to our listeners about the impact on energy prices.
No, energy prices. So, Sandeep, India largely depends on Middle Eastern countries and Russia for energy supply, and almost 30 to 40% of our energy supply comes from Russia. In case there is any disruption in that supply, energy prices will go through the roof. We have already seen crude crossing $100 per barrel in the morning. So if that pressure sustains, along with that, other elements of inflation are also there, and all of that can be significantly negative for the markets in short term. However, some of these are short-termish in nature, and once the normalcy resume, prices will also normalize. So investors need to be careful. On the war, my thesis is, I believe that it will remain localized, and I hope that it will remain localized. Last 20 to 30 years, we have seen a lot of localized wars. We've seen Israel Palestine continue for some time. We've seen all the wars in Middle Eastern countries continue. India Pakistan had its own share of regional conflicts, and so did China and India. So, if as long as it remains localized, I don't see too much risk. But the issue is, and as you highlighted, NATO coming into the picture, and then them being obligated to react to what Russia is doing. That can create a full blown war. If we go back in history and look at World War One and World War Two, also, it happened because there were treaties, and every country reacted to or responded to those treaties, obligations. I hope it doesn't play out like that this time around.
No, absolutely. I think that is something that we are already like seeing early signs of the oil crisis or the energy crisis play out. India, for the benefit of our users or listeners, imports 80% of its energy supply, which means that it puts a pressure on the current account deficit. Current account deficit is the net outflow of currency from India, and which means that potentially it can cause some pressure on the rupee. Interestingly enough, we still don't see the rupee weakening dramatically. What, however, potentially can be an immediate impact is the impact on inflation. Given how much energy contributes to our wholesale price index, it is possible that inflation may continue to rear its head. And we've spoken about this very, very recently on insider investing. If you think about it, January inflation prior to this oil price going up, the WPI, and correct me if I'm wrong, Vaibhav, was around 13%
Yeah, it's
for
it's it's been in double digit for quite some time now.
yeah, and which means that if in February and March oil prices increase further, there's a potential of inflation reaching the mid-teens also.
Yeah, yeah, yeah. No, absolutely, and it will spill over to consumer price index also, and therefore consumer inflation will also go up. Uh, Energy contributes directly also and indirectly also, even in the food prices, because transportation cost goes up, food prices will also go up, and that impacts household much more than any other use of energy.
Yeah, it's a confusing time for central bankers, especially in India also. We are seeing a strange thing, and we looked at the monetary policy of last week. Uh, there was no change. The RBI continues to maintain a dovish stance, which is befuddling a lot of economists
Yeah.
because that can cause serious impact on the currency and potentially. And to explain again to our listeners, if Indian interest rates remain lower and the global interest rates are higher, money will settle into where the interest rate is higher, which means that there's potentially a withdrawal of dollars that can happen, which is something that RBI has not reacted to just yet. Do you think this inflationary shock can push RBI into acting, or will they think about this as a short term thing again?
So I think they are taking a view that most of the inflation is because of supply constraint, not because
Hmm.
of demand push. And with that narrative, they are sitting on the sidelines and hoping that eventually inflation will normalize once the supplies resumes. But with this, I think RBI will be pushed in the corner and will have to act. So we've seen similar kind of narrative from Fed also for the longest time, where they said that inflation is transitory. Only in the month of November they admitted that it's becoming structural now. And I'm assuming RBI will also come to the same conclusion soon enough.
Yeah. So we're talking about a time when potentially inflation will rise, interest rates will can also rise.
Yeah.
If not already, we already see it in the bond markets, where at least on the corporate bond side, interest rates are increasing. We'll talk about how attractive corporate bonds are becoming right now. But coming to the market specifically, one of the data points that market analysts track is this concept of VIX, or
Yeah.
as it's called, the volatility index, which is an indicator of a potential sort of significant up and down in the market, and most likely it's down. India's VIX jumped 30% to almost 31 this morning. The US VIX is also up. What do you think is likely to be the near-term impact of these events in equity markets?
See, jump in the VIX is a nightmare for the traders. So I'll explain it to our users. So last 18 to 20 years, volatility of the market has been extremely low. And all the traders have gone short on volatility. That means they have worked with an assumption that volatility will keep going down. And it has gone down significantly and they've benefited because of that. If volatility goes up, starts to go up, these traders will be forced to unwind their position, right? And if they are forced to unwind their position, your correction will get amplified because of their action. And it will overstretch into a territory which seems unanticipated at this point. So, any kind of increase in volatility, it's not great for the short term traders. However, for long term investors, volatility is great. You get great opportunity to buy stocks at the prices at which you want to buy. Obviously, you need to have some sort of expert assistance in deciding which ones to buy. The other thing, just to build on the same point on interest rates. So what we are seeing, Sandeep, and it's very interesting. I was looking at the data yesterday evening. Nifty has corrected by 6.5% from the peak, right? From the highs of 18,500, we are down to 17,100, 17,200. So which is 6.5, 7% correction. Some of the high multiple stocks or stocks where profitability is not there has corrected by 40, 50, 60%. So that's where the big distinction will have to be made by investors. In an interest rate environment which is extremely, extremely benign, these stocks can perform well because you can live with higher multiples. But the moment interest rates start going up, multiples have to compress, and which is what we are seeing playing out in the market. So investors need to be careful about what kind of portfolio construction they do.
Yeah, I think you know, I think we'll talk about specifically about parts of the market, and there I agree. And you had mentioned this even on our last podcast that, especially in the current times when interest rates are rising, there are certain stocks which are highly overvalued. These
Yeah,
are stocks where cash flow is coming much later,
yeah.
or profitability is coming much later. Investors were tolerating that given that interest rate was low. Today, that tolerance for that has gone down dramatically, and I think that's potentially an opportunity. The other thing, Vaibhav, is this whole question of, is this a potentially going to be a regional issue, or it's going to be a widespread global issue? If it was a regional issue, then we'd potentially argue that this being a buying opportunity. If it's a widespread global issue, then is there like something for to be worried about, and then not make investments at the current point?
Uh, only time can tell about it, Sandeep. But honestly, sitting where we are today, I would advise all our investors to go slow on investing and stagger their investments. At least wait for next couple of months, and over that couple of months period, gradually keep investing your positions in the market.
Yeah.
It's difficult because there's so many moving parts in it. As I said, if NATO gets involved, then it can uh, convert into a full-blown war, and which is not healthy for the markets.
The interesting thing is that a large part of this is was already in the news, right?
Yeah,
It didn't happen suddenly. And if you look at sudden events, like I would think 9/11 was a sudden event.
yeah,
It was not something that we were expecting to happen in such a dramatic fashion. Even then, the time to recovery of the markets was, I was reading earlier today, about 31 days.
yeah,
And the Fed really kicked into action again at
yeah,
that
yeah.
point in time. So, do you think that if a full-blown crisis happens, then the central banks again will kick into action to prevent a huge hit to global economy and therefore to stocks?
They don't have any room. We are almost at zero interest rates, right?
That's an interesting
So,
point.
so
Yeah.
they don't have any room. Unlike previous crisis where they had significant room, this time around they don't have any room.
Hmm. Correct.
Inflation is getting out of hand, and if they intervene more, it will get further out of hand,
Yeah.
and which impacts the currency in a significant way. I don't think they will go very aggressive on that, and hope that there is more a short-term crisis and which will play out over next 30 to 40 days and will
Yeah.
get resolved.
Yeah, I think that's something to watch out for. I think that's a great point that unlike the previous crises, and we love saying this time it's different, but unlike the previous crises, the issue this time is that the central banks have very limited room to pump in liquidity into the markets. Which then brings me to, what should investors really do at a time like this? And one thing which we have been consistently talking about is focusing on quality.
Yeah.
And you and I do this every Sunday where we speak to a lot of our new onboarding members who are coming on the platform. One of the things that started worrying me especially is this whole thing about margin trading. For the last year, even like people who have full-time other day jobs have ventured into margin trading. And then there's this whole multi-bagger stock picking thing that is going on. I look at Twitter, and the clickbaits are that find out more about Rakesh Jhunjhunwala's next multi-bagger stock. And that to me is extremely worrying. So,
Yeah.
how should investors think if they have positions like those at the current time?
Honestly, if you have those kind of positions, unwind and migrate to safety. See, I'll tell you two, three interesting points which you asked me about. Uh, on investing, we have been recommending all our investors to have some allocation to real assets,
Hmm.
be it gold, be it real estate. And I had this interaction with one of the analysts last week, and he said, "Why are you recommending gold? It has not done anything for last 3 4 years." So my response to him was that I am not investing for last 3 4 years. I am investing for coming 3 4 years. So I can't look at investing from rear view mirror and say that because this asset class performed well, I should invest more, or because this asset class didn't perform, I should not invest money. So that's point number one. All the investors need to remember that they are going to invest for their future, not for their past, right? Second, in terms of the traps, interesting trap which I saw and I've been observing it from the sidelines is the stock called Tata Delhi Maharashtra Services Limited. The stock price went up from 10 rupees to 300 rupees, right? In a span of 2 years. So that's almost 30 times. It has corrected by 60%. Now it's down to 120 rupees. The unfortunate part is investors invest only after it has seen significant rally because they believe that it will continue to go up. And most of the money or capital allocation happens at, so let's say in this case would have happened at 150, 170, 200, 250 rupees, right? Because your belief is so strong that stock is going to go up only. And when the downturn starts, you don't have any exit
Yeah.
scope because stock hits bottom circuit pretty much on everyday basis. So stay away from these kind of bets. In short term, it looks really glamorous that your portfolio has grown by 5% on daily basis. But it can cause significant damage to your network. And we've seen it time and again. We've seen it playing out in 2006-7, where a bunch of real estate stocks would go up 5-10% on daily basis, and investors will feel happy about it. But eventually, it ends up losing 90 to 95% of its value. So that's point number two. Point number three, in terms of asset allocation, choose your asset allocation wisely. Don't ignore all the asset classes. Have some allocation to all the asset classes. There is a lot of merit in this old wisdom that diversify your portfolio. And last point is use some expert help. You'll need a lot of emotional support also. People who have seen cycles will be able to guide you much better in this environment versus someone who has not seen the cycle. We spoke about a lot of these new investors who have started investing for last couple of years. They have not seen any downturn. For them, it is important that they take some expert assistance, use some expert assistance, which will help them well to navigate through this crisis.
Got it. No, I think this is an important point, and which is why simple investments like mutual funds are hugely underrated.
Yeah.
Think about like on one hand, if for the majority of your portfolio, you have experts taking care of it. And experts at two levels, right? One is asset allocation experts, people like us, and then there are fund managers who are looking at it on a day-to-day basis. At this point, where would you rather, as an investor, have your money, right? Would you rather have it in your hands, where we are doing day jobs full time and have to pick stocks at the same time? We're handling projects which we have to deliver, in a day or two, and on the other hand, then we have to keep looking at our portfolio. That's just not viable, right? So if we have a two level of expertise, one is at the asset allocation level and the other at the fund manager level, why would you not want to have that at the current times?
Oh,
And with
absolutely, Sandeep. I strongly recommend, and both of us have been there in the markets for more than 17, 18 years. And most of my money is there in mutual funds, despite being very close to the market. And maybe because I'm very close to the market, I know that I need some expert advice in managing my money.
Correct, absolutely. And I think that is something that comes across very clearly in times like these. Our own money is not being managed in direct stock, so you can. I think that's a great point to make. And lastly, I think what I do genuinely believe, Vaibhav, is this long-term thinking is a superpower.
Yeah.
It's not easy. It's very easy to get drawn into near-term upsides, having conversations with people in parties, and people will come and tell you that, okay, I bought this stock, it did so well, and then you want to chase that. But what really is a strength, ability of long-term investors to ignore the noise and stick through asset allocation. Simple things is actually hugely underrated, and I think that's when people really make capital over a period of time.
Yeah, absolutely. You have to choose between the two. Either you can get excitement or you can get returns. So you you can't get both.
Yeah, and this is not we are not getting the right kind of excitement. So,
Yeah.
Vaibhav, you alluded to gold and fixed income.
Yeah.
I know you have them in the integrated portfolios. Talk more about how you think about that, as well as what is happening in the corporate bond space and why potentially there are opportunities piping up there.
No, interesting time, Sandeep. So if you remember post 2008 crisis, uh, even a bank like HDFC was raising money at 11.5-12%. So similar kind of opportunities are available in fixed income also, where the gap between equity returns and fixed income return narrows significantly.
Mm.
So I strongly recommend that we should look at some of these opportunities today and park some money, where you can generate good 10, 10.5, 11% returns without any volatility. And our team is working on bringing some ideas around that. So hopefully we'll share some of that with our users soon enough.
Great, Vaibhav. Thank you so much. We just hope this crisis stays contained. People are safe. I think that is more important. At least for now, money will be made and lost in the markets. We just hope that the
No
situation
lives are
remains
lost.
safe and everyone comes out of this well. Thank you, Vaibhav. This was an interesting session, and we hope to do this again very soon.
Thanks, Sandeep. Loved having this chat.